Well, let's get in the second management on our show today on Chartbusters. We have the management of Emami joining in, which reported a slightly stable-ish sort of numbers in an otherwise weak consumer sentiment as well, and as a result of which the stock too unperturbed, mildly in the red, in pretty much the similar way as the market has been as well. 1.7% in terms of volume growth, revenue growth at 3% as well. Mr. Bhansali, who's the CFO of the company, joins in. Thanks a lot, Mr. Bhansali, for joining in. You know, the first obvious question, target revenue and volume growth for the second half, given the first half saw 6% revenue growth and domestic volumes which grew by just about 5.5%.
Yeah, we expect a high single-digit kind of a growth on an overall basis. So we still aspire to be double-digit growth in the second half. We believe that the second half would be good in terms of the season, the winter and the summer both. And we are poised for growth. We have taken so many initiatives, and we are confident of delivering a high single-digit growth.
High single-digit growth on the revenue or volume?
On the revenue. So
okay, and volume
growth has been lesser by around 2%. So the price rise is just 1.5 to 2% only for the year.
All right, so high single-digit revenue growth, mid to high single-digit sort of volume growth is what we're expecting in the second half of this year. And what about margins? Because, you know, in the second quarter, while the revenues grew just about 3%, your margins moved to about 28%. For the full year, what is your guidance?
So the material costs have been very benign. Even the advertisement cost has been lesser in the first half. We observed that the markets were not reacting to the initiatives which have been taken, and so we conserved the resources, and the margins has improved. On an overall basis also, we expect margins to improve a bit, and we will be investing behind the brands also. Despite this, we expect some margin expansion.
Could you give us a band and also ad spends? First half was close to around 18.3%. So what is the ad spend band that you're looking at as a proportion of sales? And if you could give us a number on the margins.
On an annual basis, we would remain at the same level as we were at the last year. So it will be around 18% on an annualized basis also. So the second half, as a higher volume of numbers, and also the advertisement would be higher in terms of the absolute, but in actuals also, the percentage would remain almost the same as we are in the last year. And EBITDA margin expansion has happened in the first half, and also that is because of the gross margin as well as the other expenses. That trajectory would continue. We expect around, compared to the same period previous year for the full year, we expect a little EBITDA margin expansion.
Okay,
but it would not reduce.
Okay, we assume about 50 to 100 basis points in terms of an expansion out here. You know, Kesh King, it's been underperforming from the time you've acquired it, even now. So what's the revival plan for Kesh King? And if you could also give us a sense on the target growth that you have in Man Company, because after increasing your stake, the last quarter was a bit of a washout because of this transition. So on Kesh King and Man Company, what are your targets?
So for the Kesh King, there has been, because there's been a discretionary kind of a spend from the consumer standpoint, there has been underperformance compared to our expectation. And but we believe, but the market shares are intact, and we believe that in the going forward, we would be able to demonstrate a good growth there. And we also robbed in BCG, the Boston Consulting Group, for advising us on the growth strategies for skincare and hair care brands, which includes Kesh King as well.
All right.
And
we
on
hope
the
that
Man Company, as you asked, yes,
right,
because of the transition and the change in the management, there has been impact on the performance for the quarter, and we hope to get stabilized in this first full financial year, and expect moderate growth and with EBITDA positive outlook.
What is moderate growth on an annual basis? What does the revenue of Man Company look like this year?
A moderate growth could be around 5 to 10% for the full year, and EBITDA positive is EBITDA positive.
Right, obviously EBITDA positive is EBITDA positive. Final question then. You know, everyone's been talking about weakness in consumer sentiment in the second quarter, but you are in the eastern part of the country where the festive season comes in a little earlier. Have you seen any signs of revival, or do you think the second half could be only marginally better than the first half?
But our presence is across the country, so it's not just the eastern part. And but we have seen that there has been a festive, and it is also few of the category centric, where you find that the affluent people in the premium ranges, and so there has been a good spurt. in few of the channels there has been a good spurt, but in few GT channels, or for that matter for other LUPs or all, so there is still the spurt has to come. So there is a mixed feeling as yet, but we believe that the more has to be done by the season. The winter is expected to set in, and we expect the winter to be the same stronger winter as the summer had been, and this will have a good impact on the financial performance for the consumer businesses.
All right, we take that point, and for you, over 50% of your revenue is also coming from the winter product, so that would aid your growth if the winter is good. Thanks a lot, Mr. Bhansali, for joining in. High single-digit revenue growth with margins seeing a 50 to 100 basis points improvement over last year, and mid to high single-digit volume growth is what the company is poised for in the second half of this year, even as consumer sentiment is mixed. Take a